Hi, welcome to the CIMA P1 Management Accounting live online session number 1. I'm Hafiz and I'm going to take you through to a series of sessions of CIMA P1 to cover the syllabus and guide you through how to pass the paper. Okay, let's get started. Right, first of all, I'll introduce you the CIMA P1 exam, as many people are familiar anyway. The exam duration will be 90 minutes, and over 90 minutes you would be given 60 questions, 60 tasks or 60 questions. Some of the questions will be multiple choice and some of the questions will be objective tests. Multiple choice means you will be given a very short question followed by 4 options A, B, C and D, and you can choose one of the 4, whichever the right answer is. And the multitasking or objective testing is that you will be given some blanks or boxes in which you have to fill in the numbers or any words, whichever is appropriate. Okay. Your exam will be computer assessed, computer based exams. There are 4 areas of the exam syllabus. Number 1, section area A, which is cost accounting systems. Section area B is budgeting and planning. C is decision making, and finally we have the risk and uncertainty. So there are 4 areas of the syllabus: cost accounting systems, decision making, budgeting and planning, and finally the risk and uncertainty. And over a series of sessions we are going to cover all these areas. Okay, so here we go. Today we are going to talk about cost accounting systems, which is part of section area A. And in your study notes we are going to cover from pages 3 to 8, okay, which will include marginal costing, absorption costing, profit calculations and profit reconciliations. Okay, right, so here we go. Let's start our first session. Cost accounting systems. There are many objectives or aims of cost accounting systems, but the primary objective or primary aim of the cost accounting system is to calculate or accumulate the cost of goods or services. If we are working for a manufacturing organization, we need to know how much is the cost of 1 unit of output. If we are working for a service sector, we want to know what is the cost of the service, one service we developed. So cost accounting systems aim to calculate the cost of goods or services. What is the difference between goods and services? Well, there is only one difference. Primarily there is one difference, that goods have physical existence, goods have physical substance, whereas the services do not have physical substance. We can feel about a service, but we can't touch a service, we can't see a service. Okay, something like that. Now, a number of cost accounting systems are part of the syllabus. Let's start. As I mentioned, cost accounting systems calculate cost of a product or service. So here is some of the elements which are used to make a product. Whether the product is a small furniture product like a chair or any sofa or bed, or it can be slightly technical like a computer, or even more advanced like a car or any other physical product. Any product is made up of 3 basic elements. Okay, any product is made up of 3 basic elements. Number 1, direct materials. Secondly, direct labor. And thirdly, production overheads. direct materials, direct labor, and production overheads. Now, when we say direct materials make up the physical component of a product, like wood in a chair, okay, any engine in a car, which has a physical substance. We can touch it, we can see it. Now, as far as the cost of direct materials is concerned, it is very, very simple and straightforward to calculate. Accountants need only two pieces of information to calculate the cost of direct materials. Number one is the quantity, how many kilos, how many liters, how many meters will be used in 1 unit. And number two is price of the materials, meaning whether this material costs us $5 per liter, $3 per kilo, $7 per ton, etc. So quantity multiplied by price, we simply get cost of direct materials. When it comes to the direct labor, which is the human resource, staff or people who are working within the organization, within a production organization, all we need is the time, how long will it take to produce 1 unit, whether it will take 5 minutes or it will take 5 hours. So if we know the time to produce 1 unit and multiply this by the rate, generally people get paid on hourly basis, okay. Some people, you know, as far as this course is concerned, it assumes many people get paid on hourly basis. So if we know the time of 1 unit and we know the rate per hour, we can simply calculate the cost of direct labor. Not a difficult job, okay. Accountants get these informations from relevant departments. For example, the quantity of material is developed by the production department and the price comes from the purchasing department. The time per unit comes from the production manager, who knows how long does it take to produce the product, and the rate comes from the HR department, payroll department, personnel department. Accountants collect this information and then record in their accounting system, and the cost of materials and cost of labor is done. When it comes to the overheads, then it starts creating problems, okay. First of all, very quick review, what are the production overheads? So a few examples I can list down, okay. Precisely, rent, insurance, any heat, light and power, any type of depreciations, etc. Just a few examples. I think everybody is familiar. Now these are the production overheads, okay. These are the production overheads. Some of these you might have noticed, some of these are fixed for a period of time. For example, rent is paid per month or per year, okay. Depreciation is for the whole year, insurance is fixed for a whole year. But probably if you look at heat, light and power, okay, electricity, these are not fixed. Reason being, we spend money on the basis of consumption. So if the factory is running for longer hours, we may spend more money on electricity. If the factory is running for less number of hours, we may spend less money on the electricity. So that becomes a kind of variable overhead, okay. So overheads can be split into variable as well as fixed, okay. Once we know the basic understanding, let's start our accounting systems as marginal costing, absorption costing. Okay, so here is the production cost schedule. You can see that, which is simply the meaning of how cost per unit is calculated. Cost of 1 unit, which includes direct materials, direct labor, some of the variable overheads as I mentioned, right, electricity, light, heating, power, And if we add direct materials, direct labor and overheads together, we get variable or marginal cost. Please remember, direct materials, direct labor and variable overheads are variable costs. And the meaning of variable cost is the cost which fluctuates with the volume of activity. If we produce more, we need more material. If we produce more, we need more working hours. If we produce, we need more electricity and power. And vice versa, if we produce less, we need less. So that's the definition of variable cost, which changes or fluctuates with the volume of activity. As per marginal costing, the inventory is valued at marginal cost. Okay, as per marginal costing, inventory is valued at marginal cost. Okay, some people call it direct costing system as well, because materials can directly be charged to a product, quantity times price. Labor based upon time can directly be charged. So value of inventory is made up of variable cost as per marginal costing. Okay, we will see the applications of marginal costing slightly later on. Marginal costing is a decision making technique. Okay, and later on we will see some uses of marginal costing, how strong marginal costing applications are, how marginal costing will help us to make appropriate decisions. Okay, but so far, as per marginal costing, value of one unit is made up of variable costs only. Once we add fixed overheads like rent, rates, insurances, depreciations, supervisions or any fixed commitments, we get total cost or absorption cost. So as per absorption costing, value of one unit should be made up of full cost. So understanding is simply this: as per marginal costing, stock or inventory should be made upon marginal cost or variable cost. As per marginal costing, only variable elements should go into a product to make one unit of product. So we will say marginal cost of one chair is only variable cost. Whereas as per absorption costing, sometimes examiners call absorption costing as a traditional system. I will explain why they call it traditional costing system. It is made up of full or total cost. Meaning not only variable costs but also fixed production overheads. So variable plus fixed production overheads, all costs are assigned to the products or inventories, and that makes up the value of the inventory. And it looks like you might have noticed marginal costing does not include fixed production overhead, whereas absorption costing includes fixed production overhead as a product. So you would see value of a product under marginal costing will be slightly lower than the value of product under the absorption costing system. And later on, when we will head towards decision making, we will see why marginal costing is preferred over absorption costing in making decisions. Okay, when we'll come to the point, we will talk about. So that's how we make up the cost per unit as per marginal costing, as per absorption costing. Okay, let's move on. I will show you some pro formas of the income statement or statement of comprehensive income. Some people call it P&L. So statement of comprehensive income, profit and loss, or income statement, whichever is appropriate for you in your career, in your work life. This is just a pro forma. Many people have done paper CO1 and they are familiar. Okay, some people might have come through the exemptions, so they may not be directly familiar. So have a look. Sales less cost of sales. which gives us gross contribution. Then and before gross contribution, here is just one thing. Because we are using marginal costing here, so the cost of sales, which is opening inventory plus purchases minus closing inventory, is all made up of variable cost. This is all variable costs, okay? Only variable components. Okay, so sales less, you can actually make it, this is variable cost of sales. This is actually variable cost of sales. So sales less variable cost of sales equals to gross contribution, and then we subtract variable non-production costs. It could be selling and distribution, it could be any marketing, advertising, postage and packing, delivery, etc. Anything which is incurred outside the factory or outside manufacturing place. That's non-production cost. So we subtract non-production variable costs and we arrive at net contribution. Mostly, sometimes it's called as just contribution. Okay? That's the contribution. Once we arrive at the contribution, then we take away any fixed costs. Okay? With any name, fixed costs are there, whether they are production or they are non-production, manufacturing or non-manufacturing, and we arrive at operating or net profit. Okay, we'll see to this, we will prepare this as well. Here is absorption costing pro forma. Absorption costing, remember, is the full costing. Based upon absorption costing, here is the statement of comprehensive income or P&L, profit and loss, or income statement. Starting point is the same, sales less cost of sales equals to gross profit. The only difference is that the cost of sales we are making up here, calculations are based upon full cost. Calculations are based upon full cost, not just the variable cost. So variable manufacturing and fixed manufacturing costs are included in here. And then we arrive at the gross profit. Sales less cost of sales equals to gross profit. Before I move a little bit further into this, what is the main difference between absorption costing you have just noticed? Just to recall. Yes, I can hear you. You are telling me that the main difference arises only around one thing. There is only one thing which is creating a difference. So if I take you back in here on the page 1 here, and the difference is fixed overheads, and these are production overheads. Fixed production overheads. That's the key difference between marginal costing and absorption costing. That marginal costing, that's a very important statement for you. As per marginal costing, fixed production overheads are taken as expenses. We record fixed production overheads as expense after the gross contribution or net contribution. Whereas for the absorption costing, fixed production overheads are part of the product, part of cost of sales, or in other terms, they are part of a product. Whereas in marginal costing, fixed production overheads are not part of the product, they are in the expenses, just like we spend expense without relationship to the product. Okay, let's go back into there. Here was the absorption costing pro forma. So sales less full cost of sales equals to gross profit, and then we subtract any of the non-production costs, whether they are variable or fixed. Any selling, distribution, marketing, postage and packing, administrative, etc. All non-production costs are subtracted to arrive at profit. Now, there is one thing which I will leave for maybe few moments. Okay, I will cover it in this session, but it will be slightly premature for some people. Okay, I will explain the rationale, story behind over absorption or under absorption. Okay, so at the moment you can just imagine that we know how to calculate profit. adjustment of over and under absorption, I will explain how system works and how it gives rise to over absorption and under absorption and how we adjust things. Is it okay? Right. Let's have a look at some of the comparisons. Okay, but before we look into those comparisons, it's even better if we have a look at a question. Okay, if we have a look at a question, and then rather than memorizing things, through the applications we can learn what do we mean by if opening inventory equals to closing inventory, profit is this and that. Okay, it will come back to this in a moment. I'll come back to this page. Here is question number 1. Okay, and all over absorption, under absorption, everything will be covered in here. Let's have a look at the question number 1. The following details have been extracted from the budget papers of Stylo PLC for June 2015. They've given us some imaginary values: selling price per unit, direct material cost, direct labor, variable overheads, fixed production overheads, non-production variable cost per unit, and sales volume and production volumes are given, and opening inventory of finished items is given as well. So once we know there is nothing unusual, I know everything what is there. Requirements: prepare budgeted profit statements. Okay, the ones pro formas I was showing you, income statement or profit statements, using both absorption and marginal costing, and then reconcile the two profits. Meaning, when we will produce the profits as per marginal and absorption costing, you would observe that profits are different from each other. And if the profits are different, then we attempt to reconcile the profits, that what is the real difference between the two, what is causing this difference. Okay, and B, in what circumstances would both profits be equal. We will have a look at this as well. Is it okay? Right, so first of all, let's develop the income statements, and then slowly we will start catching up with those basic principles which we have left before. Before I start this question number 1, you know that there will be 60 short questions, so you will not see question like this in the exam. Okay, a requirement will be very simple and small. Well, I shouldn't be saying simple. Requirement can be any, but very short, so that you can easily manage it around 1, 2, 3, 4, 5 maximum minutes. Okay, right, so this question can be broken down into 4, 5, 6 short questions. Okay, but personally I don't know which short question Mr. A will see and which short question Mrs. B will see. Okay, because we have to learn everything, and from everything questions will start coming up. Is it okay? Right, now let's have a look at the question number 1. Requirement A, profit statements. First of all, if you allow me, I can use marginal costing. Marginal costing is slightly straightforward one as compared to absorption costing. It has less complications. Let me finish off with marginal costing, and then I will do the absorption costing and we will learn things. Okay, now income statement, profit statement starts from sales, as we all know, and then less cost of sales. And cost of sales is made up of opening inventory plus production cost and less closing inventory. Okay, some people may be working for trading organizations, not manufacturing organizations. No problem at all. In a trading organization, everything remains the same apart from this production cost. we replace production cost with the purchases, opening inventory plus purchases minus closing inventory, because trading companies are just buying and selling, they are not producing their own products. So therefore opening inventory plus purchases minus closing inventory will make up cost of sales for the trading organizations. Okay, and for manufacturing organizations, they don't purchase finished goods, they produce finished goods. Okay, right? And once we've done it, we will end up with gross contribution. Okay, I'm writing down because so that you can remember by repetition. Once we have calculated gross contribution, then we subtract variable non-production costs, any of the variable expenses which are non-production, and we arrive at contribution. Some people call it net contribution as well. From the net contribution, we take away, we subtract or deduct all fixed costs, any fixed costs, and we arrive at operating or net profit, and job done. Okay, so that's complete pro forma. Let's start picking up the numbers one by one from the question number 1. Okay, here we go. First of all, we are given selling price per unit, which is 124, and sales volume is given as 12,500 units. So sales revenue will be made up of $124 multiplied by the sales units, which are 12,500, and the sales revenue in total, okay, you can see my calculator as well, right, very small one, 124 times 12,500, which is $1,550,000. Because there are too many zeros, so if you don't mind, I can cut these short by putting them under thousands of dollars, and that comes to 15,500, 1550, 1550. Okay, ignoring 3 zeros, otherwise it would have been 1,550,000. Now cost of sales, because we are following marginal costing, so please remember again that as per marginal costing, we apply variable costing principles. Is that okay? Variable costing principles. Let's have a look at the opening inventory. They told us opening inventory of finished goods was 980 units. So we had 980 units in the opening inventory. And what is the value or cost of 1 unit of inventory as per marginal costing? Well, 1 unit of inventory as per marginal costing is made up of variable elements. Okay, so direct materials, direct labor, and only variable overheads will make up variable cost. So which is 20 plus 20, 40 plus 10, it is 54. Okay, value of 1 unit as per marginal costing is 54. So 980 units times by $54, we get 52,920, but because we are ignoring 3 zeros, it will come to 52.92. Okay, because I'm ignoring 3 zeros, otherwise it's 52,900. Okay, or if you feel you become under pressure, okay, by ignoring 3 zeros, it's perfectly fine. You can just show them in full values. Okay, it's completely your choice how your brain works. Okay, completely your choice. 52,920. Okay, there's no barring. Okay, no restriction, completely your choice. Production cost. Let's have a look at the production cost. They produced, production volume was 13,250 and value of one unit is 54. $13,250 times by 54, we get production cost. So 54 into 13,250 equals to 715,500. Okay, 715,500. And now the closing inventory. Here we go, closing inventory. Well, they haven't given us, but it's not difficult to find out. If we had 980 units in the opening inventory, and on top of this, plus we produced another 13,250 units, so doesn't it make up total units available with us? 980 plus 13,250, that makes up total units available with us. And if we take away the sales units, sold units, we end up with closing inventory. So 980 plus 13,250 minus 12,500, we are left with 1,730. Okay, so it is simply opening inventory plus extra units produced, production units, minus the sales units. Okay, so I hope all units were there. If none of the units were stolen or nicked away somewhere, we should have 1,730 units in our inventory. Times by the variable cost, again 54, and here is the closing inventory, which is 93,420. Okay, and that gives us the variable cost of sales. So opening inventory 52,920 plus 715,500 and minus 93,420, and it gives us $675,000. Okay, which is simply the sum total of this sub column. So inner column, I add it up together and total is taken to the outer column. Once I calculated the cost of sales, which is variable cost of sales, now here is the gross contribution. Sales minus cost of sales, variable cost of sales, equals to gross contribution, which is $875,000. Okay, gross contribution is done. Now we are looking at the variable non-production costs, which are here. Non-production variable cost per unit. Okay, clearly given non-production variable cost per unit, which is 12. And always remember, non-production costs will be based upon sales units, which are 12,500, because non-production are generally selling, distribution, postage, packing, delivery, shipping, etc. Okay, so it's always based upon sales units rather than production units, which is $150,000. I put numbers within the brackets, means I'm going to deduct them. Okay, and here I get at the contribution, which is $725,000. Once the contribution has been calculated, now all I need to do is pick up the fixed costs. And there is only one fixed cost given, which is the fixed production cost. Okay, which is the fixed production cost. And here is the fixed production cost, which I can take away. It is $36 per unit. $36 per unit. Okay, and what was the production volume? 13,250. $36 into 13,250. It gives me 477,000. And that simply gives me the final profit as per marginal costing, which is $248,000. $248,000. Is it okay? Job done. Now let's have a look at the absorption costing. Okay, let's have a look at the absorption costing. Absorption costing, income statement or profit statement. Okay, starting from sales, less cost of sales, which is opening inventory plus production costs minus closing inventory. Minus closing inventory. Okay, and that equals to gross profit. So sales minus cost of sales equals to gross profit. Then we subtract non-production costs, and then we arrive at the operating or net profit. Something like that. Okay, now let's start picking up the numbers one by one. Sales will remain the same. Sales will not change because simply we sold the same number of units, whether it's absorption or marginal costing. Selling price is 124 and units sold are 12,500. So 124 times by 12,500 units. Here are the sales revenues. Okay, $1,550,000. Is it okay? Right? Now cost of sales, opening inventory plus production minus closing. So I will pick up the same units, 980, 13,250 and 1730. Okay, if I can change the color you can see slightly better. 980, 13,250 and 1730. Now these are the units. Now units will not change. I mean, Whether it is marginal costing or it's absorption costing, it can be 980 cars. The number of cars will not differ, only the value of car differs under absorption and marginal costing. Now here is the absorption costing, that 1 unit of inventory under the absorption costing will be valued at full production cost, including variable and fixed production elements. Meaning to say, 1 unit of inventory will include direct materials of 20, direct labor of 20, 14 of the variable overheads, and 36 of the fixed overheads. So 1 unit will cost us $90 as per absorption costing. So 980 units times by 90, 13250 units times by 90, and 1730 times by 90, and we simply get opening inventory value plus production cost minus closing inventory. So 980 into 90, which is 88,200. Then plus 13,250 into $90, which is 119250. $500. And now closing inventory 1730 into 90, which comes to 155,700. And here is the cost of sales, which gives me a total of 1,125,000. $1,125,000. Sales less cost of sales equals to gross profit. So $425,000 of gross profit. And now we are going to subtract non-production costs. There is only one non-production cost given, which is this 12. Okay, which we had used before, and it should be based upon sales units, not the production units. So 12 into 12,500 gives us 150,000. And here is the profit. $275,000. Okay, $275,000. Is it okay? Right, that's how it works as per absorption costing. Okay, in a straightforward situation. You might have noticed that profits of two approaches are different. One approach is producing 275,000 and the other is producing $248,000 of profit. Absorption costing profits are greater than marginal costing. Okay, they are greater than marginal costing. 275 minus 248,000. Absorption costing is generating this much profit, which is $27,000 of profit more than marginal costing. Okay, and let's do the reconciliation. What could be the main reason? Okay, what could be the main reason? Now here is the profit reconciliation between marginal costing and absorption costing. First of all, here is the marginal costing profit, which was $248,000, and here is the absorption costing profit, which is $275,000. Okay, and here it looks like absorption costing generates more profit than marginal costing, and how much profit, extra profit is generated? 275 minus 248, the difference is $27,000 more. Absorption costing has generated $27,000 more profit than marginal costing. Let's identify the reasons. What could be the reason behind it? Why has it generated more profit? Always remember, as I explained before, what is the main difference between absorption and marginal costing? Yes, I hear you shouting. Only one thing, which is the fixed overhead cost, fixed production overheads. Okay, if I take you back into the original question, remember the marginal costing was only including variable elements, and absorption costing had included fixed production cost as well, and that is the key difference. Now how do we reconcile is this? Okay, the formula is fixed production overhead cost per unit, fixed production overhead cost per unit. Later on we will call it overhead absorption rate. Okay, in a moment we will call it overhead absorption rate, multiplied by inventory difference. Inventory difference is simply difference in inventory between start of the year to the end of the year. Opening inventory and closing inventory. How many units we had in opening inventory and how many units we had in closing inventory, the difference between the two is called as inventory difference. Now can I say fixed production overhead is 36 per unit? And what is the inventory difference? Well, opening inventory was 980 units and the closing inventory was 1730 units. So can we not say the difference between inventory is 1730 minus 980? Can we not say that inventory increased from opening to closing by 750 units? Inventory levels increased from the beginning to the end of the period by 750 units. That's the difference in inventory. Now what if I multiply 750 by 36? And you see, what do you get? Exactly the same $27,000. Okay, right? And that gives us $27,000, precisely the same as the profit difference. So if examiner asks you to reconcile the profits between absorption costing and marginal costing, what generally they give you profit of one approach and they give you some more details and they ask you to convert this profit from absorption to marginal or marginal to absorption. Okay, now here is the pro forma for profit conversion. If you start profit reconciliation, so the title remains the same. If you start with absorption costing profit, okay, and you adjust plus or minus fixed overhead per unit times by inventory difference, it can be plus, it can be minus. Okay, I'll explain. We will arrive at the profit of the other approach, which will be marginal costing. Or it can be written the other way around as well. You can start with marginal costing and then plus or minus fixed overhead cost per unit times by inventory difference equals to absorption costing profit. Now, what did you notice in question I had presented to you? Well, I noticed that absorption costing profit was more than the marginal costing. Okay, absorption costing profit was more than marginal costing by $27,000. And second observation was inventory increased from beginning to the end of the year. So now here some statements. If inventory increases from beginning to the end, absorption costing generates more profit. If inventory decreases from beginning to the end, marginal costing generates more profit. And if inventory stays the same, opening inventory and closing inventory are exactly the same, there is no difference in profit. Okay, and that's where I was talking about that I will come back to these statements and they will make better sense, because now you've seen the applications. Okay, right, now you have seen why absorption costing profits and marginal costing profits may differ, because of the fixed cost inclusion and non-inclusion. Okay, right, this part is done. We will come back to over under absorption as well. So now you know in what circumstances both profit be equal. Profits will only be equal if opening inventory and closing inventory are exactly the same. Okay, right, under just-in-time inventory system, when no inventory is kept, both marginal and absorption costing generate the same profit. Okay, let's have a look at another example, question number 2, just to make sure reinforce our profit statements, and not only reinforcing the profit statements, but also there is one thing over under absorption. We will cover that one as well. Okay, by the way, if you have any questions, you can type those questions on your screen. Okay, and I will be happy to answer those questions wherever any confusion arises. So if I seek your attention towards question number 2 of your P1 study notes. John PLC has the following standard cost card details. Okay, standard cost card details are always for 1 unit, meaning following details are for 1 unit of product. Direct materials 0.6, direct labor 0.8, variable overheads 0.3, and fixed overheads 0.4. Is that okay? And total is 210. Budgeted volume for the year is 6,000 units, and fixed production overheads are budgeted to be $2,400 per month. Oh, here is something. Please always remember, in CIMA P1, or I think in Life or any other paper, the idea of like and like. Whenever we compare anything, we always compare in a like with like situation. Now here is volume is given 6,000 units for a year, and the production overheads, fixed production overheads are 2,400 per month. Okay, it's not a comparison of like with like, meaning to say if the volume is given for a month, cost has to be given for a month. If cost is given for a year, volume should be converted for a year, something like that. Okay, I'll explain this when it comes in a moment. Okay, the actual results for November and December are as follows, meaning how many actual units they sold, actual production, actual fixed production overhead costs of 2 months. Variable distribution cost is 0.10 per unit, and fixed marketing contract with a local newspaper amounts to $100 per month. The selling price per unit is $4. Is it okay? The company started its operations from November. Here is, means November was the first month. So why is given November was the, what is the importance of this statement to my question? Why do I need to know this? Oh yes, you are very right. I hear you saying to me that because November is the first month of operation, so there will be no opening inventory for November. Precisely. Okay. Produce profit statements for both months separately using marginal costing. Requirement 2 is produce profit statements for both months separately using absorption costing. And then number 3, reconcile the profit figures each month. Now what I'm doing is I will give you December as a homework. I will give you to work on December as a homework, and I will show you off the month of November. Is it okay? I will show all the results of November, and December you can try it on the same lines later on just to make sure we understand. Okay? Right? If you fancy, I will do it as well. Okay, so profit statements of question number 2. First is marginal costing, second is absorption costing. Okay, here we go, marginal costing. Marginal costing profit statement for the month of November. Okay, starting with sales. So let's set up the pro forma and then we will put the numbers in there. Less cost of sales, and just to remember, these are all variable. It's marginal costing, which is opening inventory plus production costs minus closing inventory. Okay, and remember what does it give us? It gives us gross contribution. Then we subtract variable non-production costs and we end up with contribution figure. So contribution or net contribution is simply sales minus only variable costs. Sales minus only variable costs. Okay, right? I'm looking at if you have any questions so I can answer as well. Then afterwards we subtract any fixed costs and we arrive at operating profit. Or some people call it net profit. Whatever the name is, just profit is fine. Okay, so once we have developed the pro forma, now we need to pick up the numbers, but again please remember this is for the period November. Okay, so I'm only using the information for month of November. Okay, first of all, sales. We are given for November, month of November, sales were 400 units. And what was the selling price? Okay, here is the selling price. Selling price per unit is $4. Okay, selling price per unit is $4. So $4 multiplied by number of units, which are 400, and that generates a revenue of $1,600. $1,600. Okay. Now the cost of sales. Opening inventory. Can I say there were no units of opening inventory, so the value will be 0? Value will be 0. Plus production costs. They produced 475. And what is the value of 1 units as per marginal costing? Only variable components, meaning to say only direct materials, direct labor and variable overheads. So 0.6 plus 0.8 plus 0.3 adds up to 1.7 or 170. Okay, 475 into 1.7, and it comes to 807.5. And if you don't mind, I can round it off to 808 approximately. And minus closing inventory. Here is the closing inventory. Well, if they produced 475 and sold only 400, meaning 75 is the closing inventory, times by 1.7, and that gives us 127.5 or 128, and we end up with variable cost of sales. So 808 minus 128, it is 680. That's subtotal. And then sales less variable cost of sales equals to the gross contribution, which is 920. Now we are looking at variable non-production costs, which are just here. If I can show you off, variable distribution cost is 0.1, 10 cents per unit. Okay, 0.1 or 10 cents per unit. And 400 units were sold, so it amounts to $40, and we end up with net contribution. So 920 minus 40, we get 880 as net contribution. And now we are going to take away any fixed cost. Here is the first fixed cost, which is 210, and here is the second fixed cost, which is the advertising, local marketing. Okay, $100. So production fixed cost 210 and marketing 100, and we end up with final profit, operating profit of this company, which is something like $570. Okay, $570. Is that okay? There is nothing else, no other cost left, I suppose. Yes, everything has been taken care of and job done. Now we are looking at the absorption costing. Profits for November. Okay, again starts with sales less cost of sales, and this time remember please, it's absorption costing, so it should be based upon full cost, which is opening inventory plus production cost minus closing inventory, and that equals to the gross profit. We've done it before, so just building up the pro forma. Then we take away any non-production costs, and we arrive at operating profit. Okay, so far there is one more thing I'll explain at the end. Okay, let's start picking up the numbers for the month of November. Sales as usual, 400 units were sold and selling price per unit is $4. So 400 units times by $4, sales revenue is 1,600. Now the cost of sales. We know that opening inventory was 0. Production cost. Okay, 475 units were produced, and this time these units should be valued at full cost, full production cost. Okay, not just variable but full, and that is 210, which includes fixed overhead as well, times by 210. So 475 into 2.1 gives me 997.5, so I can round it off to 998. And closing inventory of 75 units times by 210 which is 158 approximately, and here we get 840 as cost of sales. Okay, 998 minus 158 equals to 840. When we take it away from 1600, we get $760 of gross profit. Now let's have a look at non-production costs, which haven't been included yet. Here are non-production costs. Okay, non-production costs. One is this variable distribution cost of 10 cents per unit, and second is fixed marketing. Okay, so first one is, let's say, marketing, which is 100, and second is variable distribution, which is 10 cents for 1 unit, and 400 units were sold, so it amounts to another $40. Now here is our operating profit. 760 minus 100 minus 40, we end up with 620. 620. Is it okay? Right? I suppose it should be okay. Now here is one issue we need to deal with before we start doing the profit reconciliations. Okay? And the issue to deal is this, that our production cost was made up of 2.1. Okay, our inventories were valued at 210. Let me take you to the question. One unit is made up of 2.1, including variable and fixed. Is that okay? Because we charged all these costs to the product, okay, so in production cost we included direct materials, direct labor, variable and fixed overheads. When it comes to the fixed overheads, what we did was 0.4, I mean to say, if I just multiply all of them by 475 units. Remember, 475 units were produced. Just want to show you something interesting. If I multiply all of these individually by 475, or I multiply just 2.1 by 475, I think I will get the same number, because that's how maths work. Okay, whether individually direct materials, direct labor, variable and fixed overheads individually times by 475 and then take them total, or 475 times by 210. In both ways, this total or that total will give us the same figure, exactly the same figure. Okay, interesting thing is this: when I come to the fixed overheads, which were 0.40, I multiplied them by 475, as I was saying before, and that gives me fixed overhead of 475 units. So 0.4 into 475, it comes to 190. It comes to 190. Is it okay? So what I'm trying to say is $190 were included in production cost of 998. So when we calculated 998, in this $998, fixed overhead was 190. And we call this fixed overhead as absorbed fixed overheads. The overhead which was absorbed in making actual 475 units. The overhead which was included in producing 475 actual units. Okay, let me show you one more thing which is given here, this little chappy in the question. What is this actually? It is actual fixed production overhead for November. So what we are trying to say now is, in our production we included 190, but in reality actually we spent 210, and there is the difference of this 190 and 210, $20 difference. This difference can be called as overabsorbed or underabsorbed. This difference can be called as overabsorbed or underabsorbed. Okay, let me explain you the whole rationale how this overabsorption and underabsorption works. Okay, how fixed overheads like rent, rates, okay, depreciations, fixed insurances, how these fixed overheads are made part of the production or product. Okay, so here is how fixed overheads are included in product cost using absorption costing. This is what we are trying to learn and understand, that we are spending thousands of dollars every month on rent, rate, insurances, depreciation and so on. How these thousands of dollars are made part of one chair, how thousands of dollars or pounds are made part of one computer. This process. Step number 1, we calculate budgeted OAR. OAR is simply overhead absorption rate. So at the beginning of the year, at the start of the year, because budgets are there at the beginning of the year, at start of the year we calculate budgeted overhead absorption rate by using this formula, which is budgeted fixed overhead for the period divided by budgeted activity for the period. Okay, and if I look at this question, what was the budgeted fixed overhead for the period? Well, here it is. Budgeted volume for the year is 6,000 units and fixed production overheads are budgeted to be $2,400 per month. So can I not say I can convert this volume per month? If I divide 6,000 units by 12 months, I will get 500 units per month. And why? Because now units are per month and fixed costs are also per month, like with like. Okay, so if numbers are, sometimes examiners make these type of tricks. So you got to make sure your numerator and denominator must be expressed in the same level, at the same level. Okay, so budgeted fixed overheads for the month 2,400, and there are 500 units per month. Now please remember, this was like with like, that you must have the same level of data on the top and at the bottom, and that gives us overhead absorption rate. If I use 2,400 over 500, which gives me or maybe it was fine, maybe little typo, 2,400 over 6,000. Sorry, it was a typing mistake. Okay, let me repeat things. Okay, let me repeat things. There was a typing error. Here it is not year, it is actually month. Okay, if it was year, I had to convert it into like with like. Okay, so my apologies. I had to convert it into like, and this like and like idea works very well, which I was showing you a moment ago. Okay, this works properly fine. Only thing is the data, there was a typing mistake I noticed. This is budgeted volume for the month. In exam there will be no typing error. Okay, so please appreciate it. In exams there will be no typing error. Okay, it was just a typing mistake in here. In both cases it is per month. So volume is 6,000 per month and overheads are budgeted to be $2,400 per month. So I can use those details exactly the same. Both are perfectly okay. $2,000 per month and 6,000 units per month. Okay, and that gives us, because I found slightly strange, that's why I picked up what's wrong with it. 2,400 divided by 6,000, we get 0.4 per unit. And I think this 0.4 you have seen already here, fixed overhead 0.4 per unit, and this is what we call it overhead absorption rate. Once we calculate overhead absorption rate, so let me repeat it, the data was perfectly fine apart from year was inserted. Instead it should have been month. Okay, volume per month is 6,000, okay, rather than year. Now this was 0.4 per unit. Okay, 0.4 per unit. Now what we do is simply this. We go back in there and step number 2. Okay, step number 2 would be absorbed overheads. Absorbed overheads will be simply OAR multiplied by actual activity. So as day by day we start producing, we keep producing actual activity. So actual number of units, 0.4 into 475 units was the actual activity, and that gives me $190 which were included in the production overheads. So overhead absorption rate is calculated at the start of the year when budgets are drafted. Absorbed overheads are included during the year on a day-to-day basis, and once we arrive at the year end, we evaluate what was actually the overhead incurrence. How do we do in this way? We compare absorbed overheads with actual overheads. Absorbed was $190 and actual, I can double check, that was $210 of overheads. And that gives a difference. Okay, now please remember, if absorbed is greater than actual, then it is over absorbed. Before I create this number, this is called as over. But if absorbed is less than actual, this is called as under absorbed. So now you can see absorbed is $190 and actual is $120. So this difference of $20 will be called as under absorbed. Under absorbed. What do we mean by under absorbed? Okay, think logically in this way, that we absorbed $190, we included $190 in the products, but we actually incurred $210 more than absorbed, more than what we thought about. Okay, doesn't it reflect overspending? That we incurred actual cost more than absorbed, more than planned. And that's why if it is under absorbed overhead, it reflects overspending. If it is over absorbed, it reflects underspending. So please remember here, overspending, what do you think, which spending is good for the company? Overspending or underspending? We are right, you are right, that overspending is not good for the company. So over absorbed reflects spending less, and under absorbed reflects spending more. Okay, and we can actually take them to the impacts on the profits as well. If we spend less, it increases profit. And if we spend more, that decreases the profit in traditional sense. Okay, when we overspend, it reduces our money, it reduces our profit. So this was the case of $20 under absorbed in our case, and this adjustment has to be done in here. If I go back to the question number 2, there was under absorbed overhead, and under absorbed decreases the profits by $20. So the actual, sorry, my mistake, adjusted profit will be $600. Later on in a different topic, this over and under absorbed will be defined as a variance. Okay, later on we will define it as a variance as well when the stage comes. At the moment, if we absorb more than actual, it is over absorbed, and over absorbed increase the profits. If we absorb less than actual, it is under absorbed, and under absorbed represents overspending, meaning less profits. Now again we end up with the same situation. that absorption costing profits are 600 and marginal costing profits are 570, and there is some difference between the profits. There is some difference between the profits. Let's have a look at the profit reconciliations. Profit reconciliation. Profit reconciliation, as I mentioned before, it is difference between the two profits. So here is absorption costing. It is part 3 of the question. Okay, absorption costing profit, marginal costing profit, and difference in profit. Okay, absorption costing profit was 600 and marginal was 570. So here there is a difference in profits of $30. Okay, there is a difference in profits of $30, and we are aiming to reconcile this difference in profits. Remember, how did we do it? The profit difference is only due to one reason, which is the fixed overhead production cost. Okay, so if we multiply fixed production OAR, overhead absorption rate, by the inventory difference, okay, first of all, fixed OAR was 0.4 given in the question. That's the fixed overhead absorption rate per unit, multiplied by the inventory difference. You remember what was the inventory difference? Opening inventory was 0, and what was the closing inventory? 75 units. 75 units. And 0.4 into 75, we get precisely the same $30, which was the difference in profit as well. So if these two match with each other, it simply reflects we haven't made any mistake. Both profits have been reconciled with each other. Okay, so if you want to present, as far as exams are concerned, examiner may give you absorption costing profit. That absorption costing profit is $600, and you need to find out marginal costing profit. Here is the question mark. If that happens, all you need to do is simply look at OAR, which is for fixed overhead absorption rate, which is 0.4, and multiply that by the difference in inventory. Okay, and look at the inventory difference. If this is like 0 minus 75, opening minus closing, okay, 0 minus 75 gives us minus 75. So 0.4 into minus 75 gives us minus 30, and minus 30, if you adjust in there, you will arrive at the marginal costing profit, which is 570. Okay, or remember those principles. If inventory is increasing, this profit has to be $30 more than that. Okay, that's how it works. Right, so please catch up with this and hope things will work quite well. If you fancy, you can develop for next month as well. As I said, I will leave that one for you as a homework. Okay, everything stays the same, just one typing error which you can see in here, which I adjusted it. Now everything is okay. Only one thing before we move forwards. Okay, on page number 8. What about December, which I'm leaving you for the homework? Okay, if your marginal costing profits and absorption costing profits can be reconciled in the same way as I have mentioned, no problem at all. Okay, or actually if I show you the December under absorption costing, because there will be over under absorption. Okay, let's do it, and if you fancy doing it yourself, please don't watch me afterwards for this question, and afterwards you can rewind the video. Okay, so here we go. Let's do the same thing for December as well. I mean, we are in a learning process. So here is absorption costing, question number 2. Absorption costing profit for month of December. Let me set up the answer plan. Sales less cost of sales, which is opening inventory plus production costs and minus closing inventory. Okay, and that equals to the gross profit. From the gross profits we take away any non-production costs. And we arrive at the profit, operating profit, net profit, or any profit. Okay, right? Let's insert the numbers, whichever are straightforward ones. Sales, starting point is sales. In December they sold 550 units and selling price given is 4, so we will assume price remain unchanged in December as well. 550 units into 4, and that gives us the sales, which is $2,200. Is it okay? Now the cost of sales. Opening inventory 75 units. Did you get me? I suppose you got me. Remember when we were creating the income statement, profit statement for November, okay, we didn't have opening inventory because this was the very first month, plus production, and then we arrived at the closing inventory of November. So can we say closing inventory of November will be brought forward as opening inventory for December? So these are the same, those 75 units which we were left with at the end of November, and now at the start of December we still have those. Okay, here we go. Right, so I suppose now it's okay. Multiplied by the full cost, which is 210. Okay, just to remind myself, here is 210 absorption costing. Production cost, which is they produced 500 units into 210 okay, and then closing inventory. How many units were sold? 550. So please look at this. When the month started, they had 75, plus they made another 500, so that makes up 575. And out of 575, if they sold 550, the remaining units left unsold will be 25. At 210. And here is the opening inventory plus production minus closing inventory. So 75 into 210, which is 158 rounded off. Then 500 into 210, which is 1050. And minus closing inventory 25 into 210, which is 52.5 or 53. And that gives us $1,155 of cost of sales. Sales minus cost of sales, we end up with gross profit 1045. And now we are looking at non-production costs, which were the same. Okay, that marketing cost, advertising is 100 and distribution is 10 cents per unit. Okay, so here is marketing remains the same, which is 100, fixed cost doesn't change. And here is variable distribution, which is 10 cents per unit for number of sales 550 units sold, and that makes up $55 of distribution costs. So 1045 minus 100 minus 55, which is $890 of profit. $890 of profit. And now we need adjustment of over and under absorbed. Adjustment of over and under absorbed. Okay, it's not difficult at all. Remember the steps I mentioned, those steps will remain the same. That at the beginning of the year we calculate budgeted OAR, then OAR is multiplied by the actual activity, and then at the end of the year we compare absorbed overheads with the actual overhead. So let's do those three steps again. Okay, number one is given to us, we don't need to calculate it in here. OAR, overhead absorption rate, which is 0.4 per unit. Fixed OAR is 0.4 per unit. Step number two, we calculate absorbed overheads, which is OAR, overhead absorption rate, multiplied by the actual activity or actual production, which was 500 units. And that gives us 0.4 into 500, which is $200. And then in the third step we compare absorbed with actual to get the over or under absorbed. Okay, absorbed overhead is $200 and actual overhead, let's have a look, 160. And this is the case of over absorbing. Over absorption by $40. Meaning to say is this: we thought we would spend $200. We thought we will spend $200, but we actually spent $160. Didn't we save $40? And this over absorption reflects a saving or spending less. Spending less. Okay, and then we can take this into the main answer plan and add this to the profit. Okay, in this case it is not under absorbed, it is over absorbed, and over absorbed overheads increase the profits, and that becomes $930 of adjusted profit. Adjusted profit. Okay, I can show you the same thing with marginal costing as well. Marginal costing profits. Okay, so again, let me repeat, if for example you want to try this as a homework for the next 10-15 minutes, please don't watch my recording or don't watch my live online. Okay, you can pause it and you can always come back to us and rewind and forward, it's available with you. Okay, right? But if you feel you want to learn it and we are still in the learning process and you fancy doing it with me, please stay with me. Okay, marginal costing profits for December. Marginal costing profits for December. Sales less variable cost of sales which is opening inventory plus production minus closing inventory, and that generates gross contribution. From the gross contribution we take away variable non-production costs, and that equals to the contribution. Okay, and then we take away any fixed costs, and that equals to the profit, operating profit or net profit, whatever you fancy calling it. Okay, let's put the numbers down. They sold 550 units during December. And selling price of one unit is $4. So 4 into 550, it remains the same, $2,200. Cost of sales. Opening inventory is 75 units, production is 500, and closing is 25. Okay. Okay, multiplied by only variable cost per unit, which is 0.6, 0.8 and 0.3, which is 1.7. And here is the variable cost of sales, 75 into 1.7, okay, which I can make it 128. Then 500 into 1.7, 850, and closing is 25 into 1.7, which is approximately 43. Okay, and that gives us 128 plus 850 minus 43, 935. I'm rounding off some numbers, okay? There are 127.5 or 42.5, so I'm rounding off. So if my final answer is different by 50 cents or $1, it's not because of any error, it's because of the decimal discrepancy rounding off policy, okay? Right, so please don't worry about that much. CIMA leaves a range, okay? So if it's slightly plus or minus, it's perfectly okay. 2200 minus 935, which is 1265. And now we are looking at the variable non-production costs. Remember, non-production costs variable given were here, we use them many times. Distribution cost, okay? So 0.1 into 550 units, which makes up $55, and we end up with the contribution 1210. Now we are looking at the fixed costs. The first one is marketing, $100, and second is production, fixed overhead for December, that is 160. So minus 100 minus 160, we get a profit of $950 as per marginal costing. So absorption costing profit was $930 and marginal costing profit was $950. Reconciliation. Profit reconciliation. Absorption costing profit is 930 and marginal costing profit is 950. So the difference is $20, and we noticed marginal costing profit is more than absorption costing. Remember, this time marginal costing profit is more than absorption costing. Right, remember the difference is adjusted by using fixed OAR, fixed overhead absorption rate, multiplied by inventory difference, stock difference. Fixed OAR was 0.40 and inventory difference is opening inventory is how many? 75 units and closing inventory is 25 units. So inventory decreased from the beginning to the end of the year and inventory difference is 50 units. And 0.4 multiplied by inventory difference, do we not get the same do we not get the same $20? 0.4 into 50, $20. And that's what we are saying. There is no problem or mistake. It is just because of the including fixed cost in inventory or not including fixed cost in the inventory under marginal. Okay, otherwise everything is perfectly okay. Under the marginal costing, fixed cost is treated as a period cost. Fixed costs are treated as period costs under the marginal costing, whereas under the absorption costing, fixed production overheads are treated as product costs. And that's where inventory valuation differs, and then that leads to difference in profit. But if inventory difference is 0, there will be no difference in profits as well. Okay, so remember those rules. Hopefully it should work. Okay, from your revision kits there is a topic under marginal costing. Okay, make sure you try those questions under the absorption and marginal costing somehow. Okay, this was the work we were doing it today, which was marginal costing and absorption costing and profit reconciliation. In the next session we are going to talk about activity based costing and little bit of throughput accounting. Okay, right, whatever we can cover. So any pre-readings in advance, okay, if you can do any of the pre-readings in advance, page number 9 onwards from your notes, if you can do any pre-readings, that would really help, okay, in order to understand. And any issues, please email us, okay, just mail my tutor, right, and the email will come to me. Go to the platform, watch the video, any problems, send us the email to us. Just make sure, if it is the academic inquiry, if it's about the studies or question, email it to the tutor. But if it's about the system inquiry, send the email to the support staff, okay, so that right person for the right job. Right, so thank you so very much for your time and patience, and I hope you must have enjoyed this session. And on this note, best of luck in your studies. Any problems, keep in touch, send us the email. So all the very best, take care, goodbye.